Personal taxation in the United States is the system by which individuals are taxed on their income, including wages, salary, and other earnings. The tax system is progressive, meaning that the more you earn, the higher the tax rate you will pay. There are multiple layers to personal taxation, including federal, state, and local taxes. In addition to income tax, individuals may also be subject to payroll taxes, property taxes, and other fees. Here's an overview of how personal taxation works in the U.S. The U.S. has a progressive income tax system, which means that income is taxed at increasing rates as it rises. The federal income tax is applied to an individual's total earnings, but the rate depends on which tax bracket their income falls into. The IRS sets several income thresholds, each with its own tax rate. For example, lower levels of income are taxed at a lower rate, while higher income is taxed at progressively higher rates. As of 2025, the tax brackets are as follows: 10% for income up to $11,000, 12% for income between $11,001 and $44,725, 2% for income between $44,726 and $95,375, 24% for income between $95,376 and $182,100, 32% for income between $182,101 and $231,250, 35% for income between $231,251 and $578,100, 37% for income over $578,101. These rates apply to taxable income after deductions and exemptions. Your taxable income is the amount of income that is subject to taxation after taking into account various deductions. Deductions lower your taxable income, which in turn reduces your tax liability. Common deductions include standard deduction. This is a set amount that reduces your taxable income, which varies depending on your filing status, single, married, etc. Itemized deductions. These are specific expenses you can deduct, such as mortgage interest, state and local taxes, medical expenses, and charitable donations, if they exceed the standard deduction. Above-the-line deductions. Certain deductions can be taken before calculating your adjusted gross income, AGI, such as contributions to retirement accounts, student loan interest, and tuition fees. By utilizing deductions, you reduce your taxable income and thus lower the amount of tax owed. Unlike deductions, tax credits directly reduce the amount of tax you owe. Some tax credits are refundable, meaning you can receive the credit even if it exceeds your tax liability. Others are non-refundable and can only reduce your tax liability to zero. Examples include child tax credit, a credit for parents with dependent children, which helps reduce the tax burden. Earned Income Tax Credit, EITC, a credit aimed at helping low to moderate income workers. Education credits, for expenses related to higher education, such as the American Opportunity Tax Credit and the Lifetime Learning Credit. Tax credits are often more valuable than deductions because they directly lower the tax you owe. In addition to income taxes, U.S. workers are subject to payroll taxes that fund programs like Social Security and Medicare. These taxes are typically withheld from your paycheck by your employer and are not progressive. Social Security tax, 6.2% of your income, up to a certain income limit, which is adjusted each year. Medicare tax, 1.45% of all income, with no income limit. High earners may also pay an additional Medicare tax of 0.9% on income over $200,000 for individuals or $250,000 for married couples filing jointly. In addition to federal taxes, many states and local governments impose their own taxes on income. State income taxes vary widely, with some states having no income tax at all, like Florida and Texas, while others, like California and New York, impose high state tax rates. Local taxes can also be assessed by counties or cities and may include income taxes, property taxes, and sales taxes. Individuals are required to file their income tax returns annually with the Internal Revenue Service, IRS, typically by April 15th of each year, unless an extension is requested. Most taxpayers will file using Form 1040, which reports income, deductions, credits, and tax liability. If you are employed, your employer will provide a W-2 form showing your earnings and the amount of taxes withheld during the year. If you are self-employed, you may need to file additional forms and pay estimated taxes quarterly. The alternative minimum tax is a separate tax calculation designed to ensure that individuals with higher incomes pay at least a minimum amount of tax. The AMT is triggered when certain tax deductions and credits are used excessively. If you owe more under the AMT calculation, you must pay the higher amount. Throughout the year, taxes are withheld from your paycheck by your employer based on the information you provide on your W-4 form. This system ensures that taxes are paid progressively as you earn income. When you file your tax return, you calculate the total tax liability, and if too much was withheld, you may be eligible for a refund. If too little was withheld, you will owe additional taxes. In conclusion, personal taxation in the United States involves a series of steps: calculating taxable income, applying the appropriate tax rates, utilizing deductions and credits, and filing a tax return. With a progressive income tax system, deductions, and credits designed to reduce the tax burden, the system aims to balance fairness while funding government programs. Understanding the basics of personal taxes can help you make more informed financial decisions and avoid surprises during tax season.